11 o'clock, so let's get going. So this week we've got Andrew McHattie with us, who's going to be talking about what happened over the course of April. And then our guest this week is Nicholas Weinman, who's the manager of JP Morgan Japanese. But first, a bit of news. So obviously a very short week, so not very much going on. Nevertheless, I've picked a couple of things out. One is Aquila energy efficiency, which is in sort of death throes, and Chrysalis is the other one. Now, for whatever reason, Morningstar do these things occasionally. Our charts disappeared, so these are taken from the AIC's site. But yeah, give you the general idea anyway. So you can see the discount on this opened up quite a bit, and it's been in trouble ever since. And really, that came down to the slow pace of investing that this fund had, and it lost its continuation vote at the end of February. And they've just published this week an AGM notice, which is going to include a resolution to put this into a sort of managed runoff, which means changing the investment policy, so shareholders have to approve this. It doesn't make sense to liquidate it as it stands. It's still too complicated, and that would cost a fortune and probably wouldn't go any faster. So basically, shareholders are being asked to be patient and improve the continuation of the fund, but with no new investments. So this is what it's got in the portfolio at the end of March. So about 38 product investments. These run up to kind of 15 years out. And that was sort of a headline that Citywire picked up. I don't think it's as bad as that, though. It's got cash of about 33 million, and 37 million is committed. So that is a interesting scenario. But all of that commitment won't be drawn down in a hurry. And they do have these Italian super bonus projects, which they pre-funded some residential energy efficiency improvements. And I think about 33 million of cash flows back from that by the time we get to January 24. So that's enough to fund all the commitments and start giving you some money back really early in 2024. But the other thing is that quite a lot of shareholders wanted to keep this going. So about 45% of those who voted. So my preferred option is to see it merge with something. It's not helped, though, that everything's gone to a discount across the whole sector. That complicates things. And also, there are very few people that would take this on because it's quite sort of complex portfolio. So I think probably this sort of managed runoff thing is the most likely thing. Unless, of course, the thing that would sort of sort it out in one fell swoop would be if the manager's got another fund where these investments would fit, because obviously it's already done all the due diligence on them. So it might be able to just sort of buy the whole thing in one fell swoop and then hand the money back that way. In which case, people who still want to be invested in the sector can reinvest their money into Tent or the SDTL fund. Chrysalis, again, we know the story of this, much all the way up and then all the way back down again, and sitting on a big discount now. It's just published a Q1 update to the end of March, and the NAV is creeping up again, which is obviously helpful. That's really driven by gains within the portfolio, and I'll explain what actually drove that in a second. But that offsetting that is sterling strength, so that's taking a bit of money off the NAV, and that's obviously affecting a number of funds. But nevertheless, moving in the right direction. Now, the key to this, because it's investing in all these growth companies, not all of which are profitable, as it says there, 38% are profitable at the end of March, and it reckons 36%, an additional 36% was funded through to profitability. So about 3/4 of the fund is funded through to profitability or profitable already. So when they did the Capital Markets Day back in November last year, they said there was 20 million that they'd identified that would be used to fund things that weren't yet profitable and needed some extra cash. And they've invested 4 million euros into WeFox in February as part of this. They've sort of reassessed the position. They don't think that's changed. So basically, we're saying that there's still 20 million less 4 million euros worth of money still to be funded. They did spend 20 million topping up a stake in Starling, which didn't go down well with some people, but nevertheless, that happened. But they have still got 55 million of liquidity left, even after that. So that there's plenty of room within this then to keep going what they're doing. This is the portfolio, and what I've done here is compared it to the position at the end of January, and you can see the big movers in here. So the biggest one by far is WeFox, where they've invested that sort of £300 million, and the whole thing was written up on the back of that funding round. Starling has also increased in value too, and I think there might be a bit of a recovery in the listed multiples. Everything else is really driven by movement in the listed comparators. The biggest change there is GraphCore. I haven't seen anything company specific that would have driven that move, and they didn't mention it separately within the quarterly statement, so that makes me think that probably there's nothing specifically wrong with it, but nevertheless, you would have thought actually, because it's making chips for AI, that it would be more popular than it is, but they still need to win over users of this technology to actually make sort of inroads into NVIDIA's market share. Anyway, that's by the by. So those top four there are all things that the Chrysalis team thinks are relatively mature, and by relatively mature, it could be that these are the things that end up being sold first. The whole portfolio is doing well on average, so we're still seeing quite strong revenue growth. The WeFox uplift, as I said, was driven by that Series D funding round. Klarna, which is the thing they wrote down, that was the big write down last year, is losing less money, and importantly, its credit losses have fallen because it's doing these sort of funding, so short-term funding for retail customers, and so that's actually quite good news. Any one of those big four things that get sold, they would help prove the NAV, and also free up significant cash to do whatever they wanted with buyback stock, make new investments. That's going to be the sort of critical thing that gets this whole thing re-rated, I think. But we just have to wait and see when that's going to happen. The other thing that might happen, obviously, is that we might see an end to rate rises and a sort of change in sentiment. I think that's coming down the line, but I don't think we're there yet. So that's enough for me. I'm now going to hand over to Andrew McHattie for a second.
That's great. Thank you very much, James. Interesting about Chrysalis improving. I'll just switch over to my screen. There we go. Lovely. Good. We will talk about what's moved in April, which overall was a pretty reasonable month, actually. I think the investment trust index was up about 2.2%. And within that, there were some double-digit gains that you can see there. And overall, I think we've seen some encouragement, actually, over this last couple of weeks in particular, with a lot of the first quarter NAVs coming out from the alternative asset trusts in particular, which have been quite stable. They haven't been great and they haven't been exciting, but I think they certainly stemmed the downward flow, and that has encouraged, I think, some buyers to reconsider a couple of these sectors. So you can see on the list here a couple of REITs, and also actually in the green here, quite a few private equity trusts. So there has been some buying, and I think it's quite interesting that maybe investors are starting to come back a little bit. The buying here hasn't really been driven by much news flow. It's just, I think, a slight change in sentiment. And that's been true for Life Science REIT, which is top of the list there, which I'll talk about now. So Life Science REIT, if you don't really know it, it's a fairly new trust. It raised £350 million at the end of 2021 for a quite specialist remit to buy properties just in Oxford, Cambridge and London for the life science sector. And the idea is to buy buildings or develop buildings and fit them out as lab space, which is in very short supply. So that, I think it had a very decent rationale, but actually from an investment perspective, it's been a terrible run. You can see from the chart that they fell quite badly last year, and the shares went down from 100 pence to a low of 58. And what was interesting here was that the NAV did drop initially because of the acquisition costs in the portfolio, and also the fact that they were paying an uncovered 4 pence dividend per share. But I spoke to the managers ahead of my April newsletter, and actually they said, well, operationally, everything's fine. It really is progressing as planned, and we can give you some evidence of our investment strategy working. And they talked about a building in King's Cross in London, which they had refurbished 2 floors of as lab space, and let it to actually a Syncona group company. And the payback for that fit out, because of the increased rent, was only 3 years. And on top of that, they would, of course, get a capital re-rating because the building was now worth more because it was a better fitted building. So the rationale, I think, was always intact, but the share price was thoroughly depressed. But what we've seen over this last month is a very sharp rise, almost 20%. In fact, they're up again today, so it's a little bit more. And I think what this demonstrates is that when there are perfectly good operational REITs that in the market where the underlying fundamentals are still quite strong, but the NAV was essentially marked down by the market and they've fallen to a big discount, actually when they bounce, it can happen quite quickly. And in the meantime, of course, you get paid for waiting with a nice yield. When I wrote about this in April, it was 6.8%, now 5.7%. And so I think there's a slight warning here for investors who are thinking, well, I see all the value in REITs and in renewables and in private equity and growth capital, but I don't want to make any investments yet because I'm not convinced the sentiment's going to change. I'm going to wait for interest rates to change the course of interest rates. I think if you do that, you may well miss out on a lot of the rally because I think it can happen very rapidly. And I think Life Science REIT shows that. So moving to the private equity sector, I just wanted to get some overview here of what had been happening with discounts, because given this modest re-rating in some trusts, I wanted to see where they stood. So I just created some charts here which plot the NAV performance on the x-axis, so from left to right, strongest performers on the right, against the current ratings in the market. So the discounts, which are on the y-axis, so we have the biggest discounts at the bottom. So if you're looking for cheap trusts, you really want to look in the bottom right-hand corner and the expensive ones in the top left. So this is against 1 year performance, which is clearly a short time period. It's probably not going to show us too much. We can see 3 I's at the top in terms of performance and rating, which seems justified. Schiehallion Fund, which is MNTN on the top left there, seems a little bit expensive, but we know from many months of seeing Schiehallion Fund on the list of risers and fallers that that's a bit of an outlier, and of clearly Baillie Gifford's reputation means that may have a slightly higher rating. Possibly ICG Enterprise looks reasonable value here, and we see Chrysalis in the bottom left as the outlier, which maybe will start to shift a little now. If we change to the 3-year chart, it looks much the same except for Riverstone Energy, which looks like a very strong performer over that period on a big discount. It did have a very good 2021, that trust, but that was partly because it was recovering from a terrible period before that. And things have calmed down there now, so I'm not sure that's telling us too much. If we ignore that one, then possibly Harbourvest Private Equity is looking quite good on that basis. Pantheon, ICG again. And again, Schiehallion looks a bit expensive. And finally, the 5-year, probably the most useful of them. This, again, shows that the market's working pretty well in correlating these performance with ratings. I think HarbourVest Private Equity is the one that stands out here. And to me, I think that does offer good value on a discount of about 47%. It does have a good long-term track record. And actually, its NAV is very stable at the moment. Its March NAV was basically unchanged over February. And so I think there is quite a lot of value still in this sector. And that rally that we saw in April was probably marked the beginning rather than the end of anything. So let's switch over to the fallers. And actually, you can see they're quite muted actually here. There were only 3 double-digit falls in the market. The rest were really quite small. But there is one theme that just keeps on running. That's China, which had a bad month. So the yo-yo that is the Chinese investment trust was on the downswing last month. I'll just talk about that briefly, and also one oddity that I think is quite interesting, and that's Crystal Amber Fund, which was down 6% over the month. So first of all, China. April was a bad month for the Chinese stocks. The chart I've got up there is actually an ETF that tracks the MSCI China index. You can see it's down, but I do find it quite difficult actually to really follow closely what's happening in the Chinese equity market. And I think it's a really tough task to try and understand the day-to-day movements. And I was quite interested in an article in yesterday's FT. We said that US investors were pulling back really from China because of political tensions. And they looked at a couple of different metrics that I hadn't really examined before. One is quite esoteric, and that was some US listed options related to an ETF in Chinese stocks. And that showed that basically the money flows had been dwindling there. And the second one was just the greater figure for the money flows for foreign direct investment into China, which was very big in January when everyone was quite excited about the reopening, and $20 billion was invested into China at that point. But it's only been $6 billion in the 3 months since. So clearly the foreign direct investment into China has slowed. But I think what these indicators tell me is that unless you're really an expert here and you're following this tremendously closely, it's awfully difficult to judge. And clearly, if American investors are pulling back from China because of political sentiment, that can change at the drop of a hat. And again, I think it's very difficult to gauge going forward. So having really spoken about these monthly swings in the Chinese investment trusts month after month, it seems to me that there are some fundamental questions as an investor you need to address. The first thing is just whether China is too big to ignore. So should you be invested here or not? And I think if you do decide that actually it's such a large and important global market, you should have a presence there, then my sense is that you really need to take a long-term view and largely ignore these monthly swings, because I think they're impossible to time. And actually related to that, point C, is that if you are investing monthly, then you can get some benefit from the volatility here. And that seems to me a very sensible way to invest in this kind of asset, where it's volatile and quite unpredictable on a short-term basis. So I think, and you can still take monthly savings plans. They're still available through platforms, sometimes through the fund management houses still. And that seems to me an excellent way to think about these. So let's finish on something a little bit odd. This is quite an esoteric one, and you're going to need to concentrate with me here as I run through some detailed figures. But it is quite intriguing, actually. So Crystal Amber Fund is an activist fund that's been going for 15 years, but it is winding up now. Shareholders want their money back. So its policy is to return capital to shareholders. But that's quite difficult because it has this concentrated portfolio of large stakes in illiquid UK stocks. And its biggest holding by far is in Hurricane Energy. And that was shown in the end of March NAV, which was 117.4 pence. So actually the shares are already at a 33% discount here. And that NAV was composed of 49 pence for Hurricane Energy and 68 pence for other assets. So that shows you how important Hurricane is. And Hurricane's a small British oil company operating just west of Shetland, about 150 million. It has a really checkered corporate history. There's been a lot of toing and froing here. And just yesterday, this is very, very timely because just yesterday, Hurricane Energy shareholders voted to accept a takeover bid by a company called Prax. And this is slightly complicated because you're only getting about, well, potentially half the money up front. So there is a cash payment, which is worth 41.6 pence per Crystal Amber share. And then there's a deferred consideration, which could be about the same again, a little bit more. And that's based on the future earnings over the next 3.5 years or so from those assets. And of course, that might not work out very well, but Prax is buying it on the basis that these are good cash producing assets. So you'd expect them to work those assets. And the figures are quite interesting because if the deferred consideration does pay out in full, then that will be 86.5 pence per Crystal Amber share. So more than the current share price of 78.5, without taking into account that other 68.3 pence worth of assets. Now, there are a few caveats here. I mean, number one is that the deal still might not go through because, there's been a history of that. Secondly, the deferred consideration might not come through very well and you've got to wait for it. And the third thing is that the 68 pence of other assets includes a stake in De La Rue, the banknote printer. And as you can imagine, in our increasingly cashless society, banknote printing is not as profitable as it used to be. And De La Rue its shares have gone down actually since the end of March. So there are quite a lot of moving parts here. But nevertheless, I think there's scope for a really considerable uplift here if you're brave. It is a speculative situation, no doubt about that. But what interests me is that something we've seen before with investment trust winding up is applicable here, that the maths gets better and better as cash gets returned. So if the Hurricane deal goes through and the 41.6 pence comes back into a Crystal Amber fund, it's going to give some of that back to shareholders, not all of it, because it's going to keep a bit of working capital. But let's say it gives 30 pence back and reduces the share price then to about 48.5 pence. Instead of the potential being more or less for you to double your money, it switches to more or less tripling your money. So the maths, is quite intriguing here. And for me, I think it is worth examining, but clearly very speculative and risky. So I'll leave you on that quite strong caveat, James.
Brilliant. Thank you. That's I love that sort of stuff. It's good. Interesting. I should have a look. I should have a closer look.
Yeah.
It's something that I followed for ages as well, but I haven't held it since I used to have the fund and had some shares in Crystal Amber then. That's a long time ago. Now, thank you, Andrew.